Welcome to the Rose Show podcast.
Well, welcome to Plant Your Money Tree with Mish, commodities, macro, and market talk. I was going to ask you how you're doing, but we already had a little chit chat. So I want to thank you so much again for being here this evening. And thank you to everyone for joining us this evening. We hope to make this space educational and fun. As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. And that's what we're going to try to do tonight, as we always learn from you, Mish. Quick disclaimer. Please do not construe this as investment or financial advice. First, I'd like to take a moment to send our hopes and prayers to the people affected by Hurricane Ian. As a former South Florida resident and having been impacted by Hurricane Andrew, I feel deeply for you all. So I wish you the best.
Yes, I
I'm Rosanna.
So I'm sorry, go ahead.
Yes, thank you. No, it's okay. No, not at all. I'm Rosanna, your host. I've been an equities and real estate investor and serial entrepreneur for over 25 years. I'm currently CFO of an international manufacturing e-commerce business and CIO of an investment holding company. Before that, I co-founded and CEO'd a commercial real estate firm, business consulting, health club, and more. So I enjoy businesses and they're lots of fun. This evening, I am honored to be here tonight with a true pioneer, one of the first female floor traders on the New York Commodities Exchange in the World Trade Center, Michele Mish Schneider. Today, Mish, you are managing director and partner of 3 companies, director of trading education at marketgauge.com. You run a discretionary trading recommendation service called MMM Advantage for active investors. And you are a partner in Wizard IP, a financial software company, and a managing member of Market Gauge Asset Management, LLC, and RIA. Therefore, it is no surprise that you were named one of the top 50 financial people to follow on Twitter by MarketWatch in 2017. And then in 2018, you were also the winner of the top stock pick of the year for Real Vision. So it is women like you, Mish, that paved the way for others, and you are an inspiration for us all. There are no limits to what one can do, and Mish, you show us that. So now, you weren't always a trader. You were a special education teacher. What was the impetus for the transition to trading from teaching? And did you know immediately it was for you?
Well, to give the very brief answer, and by the way, what a great introduction. I'm like, who are you talking about? Oh, wait a minute.
It's you.
Well, let's see. Yeah, I kind of grew up. My generation was really the first generation that was encouraged to even work and be a homemaker. And yet we were still, my parents were very middle class. My dad was a mailman. I didn't grow up with any means. We weren't exactly sitting around the dinner table talking about the equities markets in our portfolios. It was nothing like that. So I grew up in Jackson Heights, Queens, and my parents, I was very good in school. So my parents said, oh, well, you know what? I think you should be a teacher because, you'll be home in time for the kids and it's a good career for a woman. So when you say pioneer, I know that these generations after me do not hear that anymore. They may hear become a teacher, but not, because it's a good career for a woman. So that's really music to my ears right there. But anyway, I also was always just naturally interested in the different brain, not the typical brain, but I had a lot of experience through some relatives of mine that had different disabilities. And just by natural curiosity and by my natural nature to try to see the best assets of everybody, I started to get very interested in special ed. And so I became a special ed teacher. And I got married and I did everything my parents told me to do. I lived 20 minutes from the house. I got a nice little Toyota to drive. I had plants all over my living room. And I was living their dream. So that's part of the story, because slowly but surely I started to realize that it was their dream and I had sort of bigger things going on in my gut. The first thing, of course, was to get the hell out of Queens. And so my best friend from high school moved to Manhattan. So I moved to Manhattan as well. And then I wound up, and really no fault of his own, my first husband, but he was just, at the wrong time in my life as I was starting to feel growing pains. And I moved in and I met this girl in my building who worked for Merrill Lynch down on the Commodities Exchange. She was one of the clerks in coffee, sugar, cocoa. And I had no money. Teachers were making, special ed teachers at that point, I was making $9,000 a year. So never dampened my spirits at all because I was a kid. So I kind of enjoyed figuring out how to get around New York with very little money. And I became a great art for me and my girlfriend. But then she brought me down there to the floor. And I mean, I'm single at this point again. I'm broke. I'm really good with numbers. I'm seeing all these boards all around, thousands of guys running around, action. And at that moment, it was like, wow, this is unbelievable. So I noticed you have an MBA. I had absolutely no financial background whatsoever, but through just really by persistence, I wound up meeting the director of research for Continental Grains commodity division, Conti Commodities. And he and I just clicked. His name is Paul Sarnoff. He's long gone. He wrote a book called The Silver Bulls, actually. And he said, you know what? I'm going to put you on the floor as an analyst for coffee, sugar, and cocoa for Conti Commodities. And so I said, okay. And there I was. All of a sudden, I left school and I went down there and knew nothing. And I was a blank slate, which actually during the greatest time throughout the commodities market was in some ways the best thing. And in other ways, of course, also taught you, I wouldn't say there was nothing about it that wasn't great, but it taught me that you have to be flexible and realize that trends change. Nothing lasts forever because commodities went from everything to nothing as we got later on into the early decade of the 80s.
Wow. This is what a beautiful story. I have to say, I love hearing you talk. It's like so real, just hearing about your transition. And yes, I don't blame you for wanting to get out of Queens. No offense to Queens people, but I get that. So humbling. It's so beautiful. I'm sure everyone loves hearing this. This is amazing. What challenges did you face during this transition? Your parents, did they have a part in a say in this when they saw you were changing your career? Did you have to overcome any other challenges?
Well, it's funny. When I was growing up, I used to sign all my cards to my parents. Love me. I'll take care of you when I'm rich and famous. And I don't know why I said that, but I used to write that on like every card. And so somehow my parents kind of believed me, so they backed it. There was no issue there. And by the way, I want to say that I didn't abandon special education altogether. It's sort of been laced in and out of my life, and it's the premise of a lot of the stuff that I'm doing now, in terms of being able to teach in a way that takes very complex issues and turns them into something about as simple as one can get in this crazy world of finance. But anyway, obstacles. Well, let's see. People who expect when you say first woman or one of the first women that I had a really tough time down there. And the truth of the matter is I was so incredibly welcomed. All the guys, when I showed up and I had to get on a squawk box and talk about who was buying and selling coffee, sugar, and cocoa. In this case, it was sugar because it was going wild at the time. It was my very first trade, by the way. And then also talk about support and resistance levels and charts and things like that. It was the guys. I would go running. What should I say? What should I say? I'd write it down. I'd go running to the squawk box. Somebody asked me a question. If you don't know what a squawk box is, since we're talking about the relic age, it was a box sitting on a clerk's desk that you picked up, and every broker around the world for that particular exchange or commodities market or that firm that they clear through, in this case Conti, had a phone, like a hot phone, and they would pick it up. and they would listen to me talk, or whomever, whatever particular commodity it was, and then they could ask questions. So if they asked questions, I would have to say, I'll get right back to you, hang up the phone, go run, find the information, and come back. So that my biggest obstacle was just I had to learn really fast, and I did. I'm kind of a type A personality anyway, and it was a great time. And like I said, not all, but 98% of the guys down there were happy to see me. And I never thought about being a female much. I really just wanted to become a really great trader. So I kind of always came at it with that mentality. My biggest obstacle was my size and my voice, because, open outcry, right? So here I am. I'm not a very big person to begin with. And because the pitch of my voice is not loud, I had to sometimes I couldn't be heard and I would get tousled about. And that's really where I became a chartist, because I would stand outside the pit. I'd make uh, point and figure charts, X's and O's, and I started to learn patterns. And if I saw a pattern that particularly intrigued me, along with what I could see from the actual guys in the exchange in terms of the momentum and psychology changes and that sort of moment of silence where things would switch, I became really good at just jumping in when I had to, putting my orders in and then jumping out. And when it was slow, I would stay there all day and kind of bond. And it was cool. I mean, it was great. I hardly have any negative things to say about it at all. It was the most incredible place to grow up.
Love it. Sounds like a fantastic experience. So you were tiny, and now you give us the details of how it was inside. And this is amazing. I mean, just to hear that. And it's nice to hear that you had such a positive experience. And that was the beginning of your, amazing. You're like a superstar now, your trading career. I guess you were right when you signed Rich and Famous over there. You knew you had good foresight about the future.
Well,
you embrace, well,
no,
I mean,
yeah. I mean, yes, exactly. Although everybody on the floor used to say, "You want to be rich, you don't want to be famous, because then that you get known by the IRS, and you don't want that."
that's true. Exactly. I like that one.
Yeah.
You embrace the challenges and you learn so fast, and the markets move quickly and you learn as you went. And that's amazing. You never gave up and you just kept improving. To me, you embody the growth mindset. And when you talk about your teaching, you never abandoned your teaching. You're 100% correct. Not only with Market Gauge, but with the book that you wrote. You simplify and explain the markets and phases so clearly that someone who has no background in finance can understand. I loved your book. I bought it last year from Amazon, and I just thought it was brilliant. The way you simplify everything. It's called Plant Your Money Tree, a guide to growing your wealth. So everyone knows, Plant Your Money Tree.
And I think we gave out a link for, by the way, thank you,
Yes.
Rosanna. But I think we gave out a link for people who are listening tonight.
Oh,
right?
yes. Absolutely. I tweeted it. I tweeted it, and I have it right here in front of me. I just wanted to say you were a true teacher. And this book just simplifies everything. And if you don't have the book by any chance, you can go to marketgauge.com/book. I heard that Amazon was sold out of it. So marketgauge.com/book, and you can buy it there. It empowers people to rise above the market noise. And there's a lot of market noise. We have more information bombarding us more than ever nowadays. And this book gives every person the ability and tools to successfully navigate the markets. And what I like most is that it helps you become independent, and you can make your own informed decisions about your financial life. So it's a must read. Marketgauge.com/book, Plant Your Money Tree. Now, I want to ask you some questions about your book. People on Twitter and people who follow you always hear you talk about this humanized economic modern family, and you personify them so well. in such a quirky way. The indices and sectors, they come to life in a very colorful way. And this is exactly your superb teaching skills coming through. Could you please tell us about this family and its family members, please?
Oh, sure. Yeah, I'm not done with them either. I mean, I'm currently working on a second book, but the book is not going to be like a regular kind of book like that, like Plant Your Money Tree. It's going to be a series of evergreen videos accompanied by PDFs that will feature all the Economic Modern Family individually with charts and anecdotal stories showing how each sector has guided us through basically every market turn. And I'll probably start, the book starts in 2008. I'll probably do this second book more from 2019. Um, but it started out kind of like a fun thing, a way to entertain myself. I am an actor as part, I also love to act. So I've done a lot of stage here in Santa Fe in particular, where I always get cast as some kind of a character and unrecognizable as that character, where I'll be in a wig and I'll be 85 years old, or I'll be 30 years old, and with good makeup and the right wig you can kind of pull that off. And so my mind works like that, tells stories. I like stories and people. This as an educator, and even with your kids, what do they remember more? When you tell them a story, they say, tell me the story again and again and again. So I started thinking, how does this whole crazy thing work into a story? So I started realizing, just by following charts, that NASDAQ may be growth stocks that lead, and a lot of it had to do with low taxes and low interest rates and corporate buybacks. And obviously technology is something that we're going to experience more and more as we grow as a society. But it was the nuts and bolts of the Russell 2000 that really dictated ultimately what was going to happen with the US economy. And it may not lead necessarily right away, but if it couldn't catch up to NASDAQ in particular, you knew it was just a matter of time till all these big growth stocks would look around and say, wait a minute, the industrial manufacturing side of the US is not keeping up with this technology, and everything's coming out basically from India, China anyway. We're not really doing anything here other than brain power. So I said, what does this Russell 2000 mean? And I started thinking, Russell, oh, it's like he's like the granddad of the US economy. So that's kind of what launched it, was Grandpa Russell. And he really is the granddad of the US economy. When you think about it, all 2000 stocks are manufactured, even if they have presences outside of the US, they're all manufactured within the United States, which means if we're not seeing huge GDP growth, it's not going to be because Apple isn't doing great. It's going to be because we're not really producing in this country the way we should be producing, and we're relying more on what we're importing as opposed to how much we are exporting. And certainly we know that's the case, right? So then I started thinking more, well, okay, but Grandpa's not alone, because we need a consumer. So then I was thinking, all right, well, he needs a wife. Well, what's the actual 70% of the gross domestic product, and probably the most important aspect of the US economy? I mean, all economies, but this is US centric, and that's retail, right? So I started thinking, okay, I started realizing, well, when you go to the mall, you often see these little old ladies running around, and actually there's, even here in Santa Fe, there's these little groups of women that go and they play mahjong in the mall, or they walk around in the mall or whatever. And I thought, okay, granny retail. And that was really the nucleus of the family, was those two. And then I just started thinking about what other big factors in terms of sectors really influence the actual economy the most. And that's when I finally came up with semiconductors, biotechnology, transportation probably was the next one, demand, and then regional banks, not big banks. And when I put them all together, I started looking at their charts as 6 different frames, which I do very often still, and I'll post it. And I realized when they're all working together, man, that is just the greatest thing, whether they're all going up or all going down. And when they start to show some kind of disparate type of behavior, generally that's trying to say something. And I can't tell you how many times I've seen like the Russell top out first, or retail top out first. And even if the SPY and the Qs are still going, we'll start pulling back on anything new in terms of longs. And I'll start putting out these caution signals, whether it's in my daily blog that I write every day, or, obviously I've been a lot on the media. I'll go on and talk about it on the stations and say, hey, not everything looks as great as watching the SPY or the NASDAQ right now. There's this modern family. So then I met a cartoonist, and she put my imagination into an image. And then I met this woman who did dolls, and she turned them into dolls. So we're working with that now. We really want this to be a financial literacy way to modify it to kids if we want, to college curriculum, all the way to very sophisticated investors like you, who can sink their teeth into something.
I love it. This is brilliant. It's exactly right. Teaching kids learn from experience, from touching, experiencing, acting out situations. That's how my kids are. I have 3 of them. I have 3 boys, all preteen and teen. And yeah, they learn by being immersed in the activity. So having dolls like that, or maybe a puppet show or something like that, teaching financial literacy to kids is fantastic. I mean, financial wellness, it should be part of our curriculum from a young age. So I love that. I mean, this is brilliant. So are you saying in book number 2, we could have additional family members?
Well, there'll be relatives, right? I talk about them in the way of relatives, and my imagination sometimes runs wild. I did a whole parody a couple of years ago on National Lampoon's Christmas Vacation, because that is a family, right? But instead of, the typical characters that you see in National Lampoon, I use the Modern Family, and then who were the influences, like Uncle Eddie, turned out to wind up being Uncle Ute, which is utilities, because I have the saying, if Uncle Utilities shows up the door drunk, it's time to pay attention. I had Aunt Edna, I made that really and Janet after Janet Yellen, and that became like my interest rate mem. But they may not be represented, because you don't want to go too far when you're first doing an introduction. But yeah, that's like future, is the different varying characters that come in and out. And some of them don't have to be characters. If you want to depict real estate, we could just talk about the family in terms of their reaction to their mortgage, the value of their house. It's once you get involved into the mindset of every member tells a story. You don't have to worry about keeping it in characters. You just have to make the stories more broad and more memorable.
I love it. It's genius, brilliant. I think it's fantastic. I think that's great.
Thank you.
So you're welcome. And so you are the creator of this Economic Mondern Family, and I love it. I can't wait to hear about their extended relatives in your next book. That's going to be fun. So tell us, what is this family telling us about the market right now? Are they a little dysfunctional right now?
Well, what's so interesting is I went on a few things this week to talk about the fact that transportation, the Russell 2000, and the retail sector, all 3 of them hit down on a major moving average. I like to use, because I like to go out. One of the things you learn about in commodities when you're looking at cycles is, obviously, if you're a day trader, you're looking at it in second to second, and you don't really care what the trend is, because you're going to buy the momentum. If everybody's buying, you buy. If everybody starts to sell, you get out. But then I started stepping back. Remember, my size meant I had to come in with a bias. So I started looking at daily charts. I had to create them myself, weekly charts, and then monthly charts. And then when I started to learn about the whole idea of a moving average, I learned about the 80-month moving average from these twin sisters called the Aden sisters. They live in Costa Rica now, I think. And I started studying that. And so, getting back to the family, when they all touched down recently on the 80-month moving average, I actually talked about it last week on Charles Payne's show, and then I talked about it on Bloomberg yesterday. I thought to myself, this is either the most major support to say that this big 6 to 7 year business cycle of economic growth after the 2008 financial crisis, we're testing the lows of it and we're going to hold, or we're going to break down below it and we're going to see a whole other leg lower, and these calls for 3,100 or whatever will start to look pretty accurate. So yeah, I mean, I didn't look. Everybody talking yesterday about the SPY closing on new lows after the June low. I was focused on IYT, transportation, XRT, retail, and IWM, or the real crux of the inside of the U.S. economy sectors. And I'm saying to myself, this could be one of the biggest support levels, at least for a bounce. So that's how I was seeing it, really.
Nice. Very nice. Yeah, you spoke about the 80-month moving average. I've been looking at that, and I did watch one of your shows. You have so many shows. I'm trying to keep track of all of them. I love them. You're excellent on TV and interviews. In your book, you talk about the 50 and 200 weekly moving averages. And I know we always talk about in trading the 50-day and the 200-day, but in your book, you say the 50-week and the 200-week moving average. Why those specific times? And are those your most important ones?
Well, I like when you step back, you look at the monthly, you look at the weekly, you look at the daily, and then you look at the 30-minute charts with pivots, because I'm a big fan of the floor trader pivots, which is the high-low close divided by 3. Every trading platform has one. What I really like is I like symmetry. So if I see symmetry among all of those different time frames, then I have the most confidence to get my people into a trade. As you mentioned, my service, my Mish's Market Minute Advantage, I have a lot of people who are depending on me to make sane decisions. So as a result, the 200-week moving average really, if I were looking at a 6 or 7 year cycle with the 80 monthly, and then with the 200-week more of a 4-year cycle, and then with the 50-week more of a year cycle, you start to think and you can see breakdowns of these cycles that happen faster and faster. Then you have the 50-day and the 200-day. So we can start with a 50-day moving average breaking down, which is exactly what happened in November of 2021. Then go to the 200-day moving average breakdown. Then you look and you see the 50-week moving average starts breaking down. And then you say, wow, how bad is this going to get? And that's really amazing, because if you look at the Russell, the transportation, and the retail, they all broke their 200-week moving averages. So it's showing you the stress of these interest rates. But semiconductors, technology, held it almost to the tick yesterday. So, that's why I like to look at all of them. And then I will look then for the daily chart, sometimes last, to see, am I seeing a reversal pattern? Am I seeing a mean reversion pattern? Am I leaving a new 60-day low with a big up day with volume the next day, kind of like what we saw today? And can I support that really on the longer term time frames now? Because what it's telling me is almost like layers. I'm seeing things in layers. I'm seeing long term, yeah, things look bad, but they're not that bad. Intermediate term, yeah, they're bad in certain sectors, and that's a warning, but yet others may be actually telling us that they can recover. And then daily, okay, well, here's my risk. That's to me, the most important thing about the daily chart is where your risk is going to be. And then the half an hour chart, which is really more like we get through the first half an hour of the day. The noise, for the most part, is done, because a lot of people are getting in and out of stuff in that first half an hour, which means if it breaks out over that half an hour high or breaks down under that half an hour low, most likely there'll be some follow through. So you see how it all works together. That's a process.
I love it. It all fits together like a puzzle, like all the different pieces to a puzzle, and they all come together. Now, if someone wants to follow you or become, as you said, that what service do you offer? You had made a mention of a service you offer. People rely on you for these chart pattern recognition. What is that service, and what's that website in case people want to sign up?
Well, it's Mish's Market Minute Advantage Premium. And we have a couple of things that go with that. If you're really a novice type of trader, and I get emails and tweets from people all the time, I'd like to learn more. We have a course that's called the Mish's Ultimate Trading Program. That's one thing. But if you just want the service, basically what I do is I live coach every week. I give you actual trade alerts. So you get a text and an email with the entry, the stop, the target, and then you have a real live portfolio that you can track. My track record is extremely transparent because it's great. and you learn from me. So it's kind of like trade what I trade, the old give a man a fish. I'm giving you a fish, but I'm also teaching you how to fish. Raul, don't bark. Sorry.
It's
So
okay. I love
yeah.
that. Yes.
So anyway, that's really Mish's Market Minute Advantage. You can find it on our marketgauge.com site, or you can tweet me. We also have somebody working with us named Rob Quinn, and he will walk you through all our products, because my product is only one. Market Gauge has a plethora. If you want quant models, if you want educational things like on the opening range I just talked about, or you want tools, that we've been in the publishing business, financial publishing business, for over 20 years. So we got a lot of stuff. But that's
Wow.
my thing right there.
That's awesome. Cool.
Yeah.
Very cool. I love how you describe and talk about the big 6 different phases in the market. You make them so simple. That's the beauty in the book. Everything's simplified. Can you just tell us a little bit about these cycles and how you're finding opportunities during our current market cycle, which I assume is bearish despair? Could you just tell us a little bit about that?
Well, let's go back to a story, right? Because since we love stories so much. So think about the family now, and they're in a car. Only now they have a navigation system. And the navigation system tells them whether they're going north, south, east, or west, whether they should make a U-turn, whether they're going in the right direction or not. And that's what these phases, we call them phases. This is not a new concept. Since Charles Dow, he actually talked about phases back in the 1800s. Essentially what it does is it uses in this case, you can do it on a weekly or a daily basis, but it uses the 50 and the 200-day moving average, where they are relative to one another, and where the price is relative to the 2 moving averages, to tell you what the phase is. So clearly, when, for example, if the 50 goes over the 200 and the price is above both, and the momentum is good because the slopes are pointing up, and it's just happening where it's just clearing those moving averages, or it's already cleared the 200, that's a phase. Now it clears the 50, that's a bullish phase. That's probably, in terms of being in a car, it's when you're going to get the most traction and go the most miles, before you run into car trouble, so to speak. So that's kind of where that comes from. And there's 6 because everybody knows bullish and bearish, right? My favorite phases, though, are the in-between phases. So when we go from a bullish phase to a caution phase, which means we've been up above the 50-day moving average, and now all of a sudden the price starts to weaken, it stays under the 50-day moving average, and it's literally caution. Like, do you want to continue to buy when we're going into a caution phase? And then it goes, if things deteriorate and it breaks the 200-day, you're going into distribution phase. And so when you hear about $9 trillion or been wiped out of the market, that's literally what distribution means. Things go from equities to cash. And then the bearish phase. So my other favorite phase besides caution is when you're coming out of a bear phase. And, we all live on hope, right? So everybody loves to see us come out of the doldrums and start doing better. We go into a recuperation phase. So it goes back over the 50. We're not there today, nowhere near it in the indices or any of the key sectors. So even if you missed this first part and you wanted to wait, like if you look at 2008 in my book, I talk about what happened in 2009. We started to clear that 50 week. By the time 2009 was over, you certainly didn't miss the move, right? There was a tremendous move after that. So those really help you decide that you're in the right phase at the right time, or your car is pointing in the right direction and everybody in the car is singing, 100 bottles of beer on the wall, and not like, oh my God, we got to pull over and to the gas station because we don't know what the heck we're doing.
I love it. You make everything into a story. It makes it so much more fun. I mean, it's really great. You talk about the recuperation phase after the bearish phase, which signifies hope, and then the accumulation, which signifies optimism. How do you spot that follow through, and which is the better time to buy, in your opinion?
I am sort of a contrarian by nature, but a contrarian with a strategy. So, when I go on with people and they say, the market looks so horrible, it must be a buy, that's not the kind of contrarian I am. I would be the kind of contrarian where I would see a major moving average cross, let's say, and it doesn't have to be in all the indices because you don't have to be in everything. Let's just say, for example, semiconductors, let's use that, pretty darn far from its 50-day moving average. But if in the course of the next couple of weeks, months, or whatever, it doesn't mean I wouldn't trade until then, but I would trade much more actively. But let's say we do see something cross that 50-day moving average and hold for a couple of days. That is a really great time to buy because the masses haven't gotten in it yet. Accumulation is exactly the opposite of distribution, in that that's when you start to see people take their cash and start to accumulate stocks. And of course, bullish, now everybody's euphoric, and that's a whole other thing. So that's why those in between phases are intriguing to me, because if you're already long in the recuperation phase, and now you start to see it clearing the next moving average, which would be the 200, to put it into an accumulation phase, now you know that you're going to start hearing people, see it on Twitter or whatever, talking about, you know what, semiconductors are a great buy. And you're going, I'm already long. So, that's how I use them, the phases, as not necessarily contrarian, but to be well ahead of the curve.
Nice. Are you seeing any type of accumulation right now in any particular sector or stock?
Well, interestingly enough, there was a couple of stocks that went into a bullish phase back into a bullish phase today, or at least held a 50-day moving average. I mean, I'm not sitting in front of my screen, but just off the top of my head, Cameco, which is uranium related, was one. Another one was Foot Locker, interestingly enough. There was a couple of ones that crossed into a recuperation phase. One I was very vocal about recently on the media was Rivian. We had bought Rivian before it crossed the 50. I will do that. I mean, listen, I've been doing this a long time, so I sometimes will anticipate, as long as I have a good reason for breaking my rule. But even if you knew nothing else, it broke the 50 today. So it's going into a recuperation phase. So yeah, I mean, we have a special proprietary indicator also that you get as part of the service that tells you when things are changing phases. So you sort of get alerted, so you don't have to sit there and look at 600 charts and wonder where they are. But in terms of the sectors themselves, I mean, really, basically nothing in terms of the heavy duty sectors are showing anything even close at this point of getting into a recuperation phase on the daily. But like I said, on the weekly, to me, what was so intriguing was the semiconductors, because they're the most interest rate sensitive, right? They held the 200-week, which means on a weekly basis, they never went into a distribution phase. They've just been in a very strong, cautious phase since they broke down under the 50-week back in January.
Very interesting. I noticed that. I think you tweeted about that, or I saw that on your site regarding that. You were very interested where it closed. Right now, 1994. It closed today, the semiconductors. So yeah, very interesting. I agree. I've been watching CCJ, uranium, Cameco. I think that's probably the top uranium play in my opinion, and I've traded it before. But yes, I noticed that. I think people are trying to find alternative energy sources, and uranium and renewables as well. Enphase is still looking pretty strong, and First Solar today seemed to have been picking up some steam as well. So yeah. I also love math, and especially geometry. In your book, you talk about geometry and how it helps with charting. I love how you apply the geometry with the charting, and your charting is just brilliant. And you seem to find opportunities in any type of market. And that's what I love so much, is that people are just so collectively saying, oh, it's a bear market, I got to go to cash. I can't buy anything. And it's like, you're finding opportunities all the time. And I just think that's amazing. You're a true trader.
Well, thank you. And the only I actually kind of went to cash only in the last couple of weeks. Well, actually, only in the last week. Not because I thought we were entering a bear market, because we've been in a bear market. I've been trading all along, all year. But because I wasn't sure if we were going to go into a further and deeper bear market, or whether we were going to do exactly what we did today, which is hold and get a relief rally. So, yeah, I mean, the charts, listen, price is real. Not everything else is conjecture, but price is real. Geometry comes in because we all have a sense of pattern recognition, number one. Some are better than others at it. And we all have a sense of probability based on, if this happened, then there's a good chance that's going to happen. And that's why I like to layer it so much and not rely on one indicator or one chart. But yet I also don't believe in too many indicators and too many moving averages and too many charts, because then you get like paralysis analysis and you can't do anything. So, when people come at me with a lot of the other different types of analyses, MACDs and Fibonacci's and Elliott waves and, VWAPs, and there's like a million things you can do. I don't poo-poo them. I just say, make it so methodical as part of your analysis that you always use the same thing over and over, or in essence become an expert at one thing. And you won't need to necessarily look all over the place, or certainly get your financial advice from the news, of course, unless you're listening to me. Haha. So
We all listen to Mish. That's the key. I tweeted that today. Always listen to Mish. But yeah, I think it's great. You need to start small, learn the few first, and then you can add a few more. So yeah, absolutely. Now I want to move over the one last time, marketgauge.com/book. If you don't have the book yet, Plant Your Money Tree. Let's move over to more current issues. Now, last week, the big talk of the week was the Fed. Of course, they're talking this week still, but the big Fed meeting last week. And, do you think the Fed will be effective in controlling inflation via their rate hikes?
If they're lucky, I think certain aspects of inflation, they obviously are already controlling, because you see a lot of the analysts and charts saying that inflation has peaked. But again, this is really where my old commodities days kind of comes in handy, because this was exactly the situation we were in the late 70s. Except for a pandemic that led to this great surge of demand and low supply. Obviously, in the 70s, it was a little different. The parallel is that the Fed, and if they mirror this, it could be exactly the same thing. I mean, I don't know what's going to happen with the Bank of England, and whether the Fed will follow suit or just do nothing for the next few weeks, which will be interpreted as bullish. But essentially, they eased up on monetary policy in 1977 after jacking up the rates after the oil embargo and driving the economy into a recession. I mean, history repeats, right? And then once they eased up, you had geopolitics, you had the end of the Nixon era, you had Carter, become president. There was a lot of government spending. And I never ever say anything political other than whether it's a fact or not. I never put an opinion on it, because that's dangerous for trading. But all this happened, and then you had some geopolitical issues. And I remember back in 1980, all of a sudden there was a beet issue in terms of sugar beet in Russia, and all of it, and now everything started going crazy, because it was at the point now where nobody was trusting the government, nobody was trusting the banks. We were done with the gold standard. They found themselves with a shortage of everything, and the speculators just came in and took advantage, until obviously the Volcker thing that happened in 81 or 82. So here we are. So we're almost mirroring it. The Fed's getting a little aggressive. They're getting a little afraid of the recession, but yet they're still talking tough. But can they really control what's going on right now, particularly with food? And I've been talking about food since 2019, because it was so obvious. All these farmers, because prices were so cheap, cut back. And so the amount of crops and the amount of, let's say, even coffee beans, and the amount of mining that was going on, everything got pulled back, because that's what commodities are all about, by the way. They're a hedge for producers. That's how they got started in the 1700s, corn farmers. If they were going to have a bad crop, and they knew that that prices could go up, they would buy the futures market so that it would compensate for the loss of being able to actually sell their corn, and vice versa. Nothing much has changed except the complication of people's minds. So that's what you have to look at right now: is there enough food? Well, certainly Mother Nature is having her fun all over the place. I saw a video yesterday, somebody posted on Twitter, of people fighting over a pound of sugar in Tunisia. And we know there's been problems, food shortages all over the world. You know, in this country, we don't necessarily feel it in the same way, but you can get into a hoarding mentality very simply. We did it in the pandemic. We can do it if we get into any kind of great social unrest. You know, there's so many things that could happen right now. But even if we forget about all of that, can the Fed interest raise themselves enough to finally control the food prices? Yes. Are we anywhere near that now? No. Is there a consciousness of the fact that A, we have a midterm election, and B, the Fed is being pegged as the evil doers in raising the mortgage rates and putting people out of work and crashing the housing market and demand destruction in so many other areas? Yeah, they're conscious of that. And look what happened with England. Now, in England, obviously there were other factors involved, but still, I still think we could be heading into a sort of a super cycle of commodities that has been triggered by food, but ultimately is trickles to the precious metals. I still say I'm watching for that, because when you lose credibility, as the Bank of England just did, central banks all over the world could wind up following. You know, obviously geopolitics and the fact that we keep throwing money at wars that people don't feel will ever be resolved, or the fact that even our own Federal Reserve's credibility is now in question. Once you get where people don't believe anything, and that's what happened in the late 70s, they turn to gold and they turn to silver because it's a hard asset. And I know this generation can't even fathom it. And I get argued with constantly: gold's dead, gold's dead. There's only one other thing that could possibly come back as some kind of an asset that people can sink their teeth into, and that would probably be Bitcoin. But we know Bitcoin right now is still very speculative and tied to the interest rates. And so is gold to a degree. Like I said, until we get some kind of a chaotic environment, and we're certainly seeing chaos not only by Mother Nature, but geopolitically in other parts of the world. And sometimes we've kind of parked right alongside of chaos right here in this country, which we all hope and pray doesn't happen. But, you know, people can only be pushed so far when it comes to their pockets.
Agree. You know, I tweeted something, I read something from Pinkerton saying that elevated inflation causes higher crime, violent crime. And so, yes, absolutely. When people are pushed, when they can't afford basic needs and food for their family, I mean, they're being pushed. So I agree with you. And there's food inflation is real. And we have droughts going on, geopolitical issues. And we have a high component in shelter as well. It's very costly. Rents are going up. Home prices are barely coming down. Very slow process there. There are a lot of moving parts and issues. I love your commodities background, and your take on commodities makes so much sense. And I love that you looked at the 70s and 80s. You know, that famous phrase from Churchill: those who fail to learn from history are condemned to repeat it. I think a lot of people, you know, don't go back to history. They're not, they just don't refer. They're very short-term memory, and they don't go back to that time. I think there's a lot to be learned from the 40s, the 20s, 30s, and 40s are somewhat of a quantitative rhyme to the 2000s, 10s, and 20s. I like studying history. And then I also looked at the 70s and 80s, and you make a brilliant point. And I think it's so important that we talk about the commodities. And I'm going to first go to Powell and what he said last week in the Fed speech. He said that commodities have peaked. Do you agree with that statement? And what are your thoughts regarding that?
Oh, you mean the guy who 2 years ago said that inflation wasn't a problem? That guy?
Yes, that guy.
I think I could say at this point, I've always wanted to say this. I rest my case.
I love it. Okay. I guess that was a Barbara Walters question, right? Or something. That was a good question. Okay, I got you. We got the answer there.
Right.
So you touched upon gold, and I think I agree. I mean, when everything else is inflated, everything else fails, what's left but the precious metals? So what do you see going on right now with gold and silver and crude and Kane? I know you're a fan of Kane and agriculture and fertilizers. If you could just talk about the different commodities, what you see going on right now, and what do you believe can go on? You did tweet that commodities and equities can both go up, and then at some point, commodities don't stop. So if you could just talk about that briefly, I would appreciate that. Thank you.
Well, thank you. Based on that statement, which is my pinned tweet, this is kind of what we're setting up for right now. I mean, it's sometimes a little scary when I get a vision of something like this. I pin it to a tweet. I mean, I may have even looked foolish for a minute or two in the most recent downdraft of all the commodities and all the equities. But it was almost like, again, going back to history repeating, I actually really never thought that the Federal Reserve would. I was kind of hoping, by the way, that the last meeting they would go 1%. And when they didn't, I knew that we were going to see the initial downdraft because everybody was going to go, oh, they got room to go more. But even if they go to 4.25, 4.5, and who knows if they will or not. The point is that, like I said, we're in a situation now where inflation hasn't peaked, it's plateaued. Certain areas of inflation obviously will never be back to where it was post-pandemic because, supply chain just literally stopped in everything. But nonetheless, the damage, just like you said before, Rosanna, the damage of inflation, even at a plateau, if it gets any accelerated further because of any reason, again, will be tied to essentials, energy and food, then you're going to see another leg up, particularly in those areas. Wood, it's gotten beaten up to a pulp, no pun intended, because obviously as the interest rates go up and the recession started to kick in technically with the GDP. I think we have GDP tomorrow, as a matter of fact. Something like wood is going to go down. But that's why I'm so focused with the agriculturals and with the energy market in particular. I was actually listening to somebody today and made a really good point. We released reserves in the United States for oil most recently. Um, and yet, since we're not necessarily drilling anymore, while we transition to alternative energy and people still use, obviously, oil and gas globally, as we can see, the havoc that Russia wreaked, that could still be another leg up there. Even though alternative energy has been doing great, like you mentioned before, for solar, that's more based, I still believe, less in reality and more in speculation. So I would watch for potential reversal there. Sugar to me is the greatest secret. Well, not so secret since I've been talking about it for so many years, but secret barometer for inflation because sugar is in everything. Insidious, right? It's in everything. And just, all of a sudden live with a diabetic and go to the supermarket and try to buy things without sugar, and you'll see it's in everything. It's also a comfort food. It's also in poor regions, the cheapest food. So that's why I like to look at that. So if you really want to see, right now, sugar is done, well, it's gone up a lot since 2019, but in the last 6 months, it's just going sideways. It hasn't gone down with the rest of the market. It's just gone sideways. It's still, if you look at a weekly chart, it may be underneath the 50 and 200 week moving average a little bit here. But if you look at a monthly chart, it broke out of the 80 month. which means it took a 6 or 7 year cycle of being down and reversed it up. And it's just scraping along the 80-month moving average. One catalyst. You don't even have to look at all the other things I just mentioned. Just look at sugar. One catalyst that spikes that sugar back up, and you know that things might get out of control. So that's my best tip.
I love it. I mean, I guess it's a pipe dream to think we're going to give up sugar. So I guess Kane, I know you talk about Kane a lot, and I've been watching your videos and you mention it, and interesting play. May I ask, are you long Kane?
Our fund is long Kane. I took my subscribers out of it. We wrote a really nice trend there. Sorry, my husband just came home.
Oh, okay.
And now I'm on the hunt. I'm on the hunt to get my
Ah,
house back in it. And you mentioned, right, we all try to get off of sugar. That's when things are good. In kind of
yeah.
great economic times, you can say, you know what, I'm going to buy organic products with stevia in it. I'm going to buy, sugar-free things. I'm not going to even eat sugar. I'm going to eat healthy. And then prices go up. And all of a sudden, all that goes by the. That's why you seem to understand why it's such a great barometer. It really gives you the psychology of good times versus bad times.
Smart. So everyone keep your eyes on Kane. You can spell that Cane. It's one to watch. I'm definitely going to be watching that one much more closely now. And agriculture, I love DBA. You talk about DBA. I think that's fantastic. I love DBA as agricultural play. And fertilizers, are you still bullish on fertilizers? Like, I remember they had that big run a few weeks back, or maybe it's been a month now. I don't remember. CF, and there's the Mosaic, the NTRs. Are you still feeling those or for the future? Because they talk about the second half of the year, their earnings are going to be strong. What are your thoughts with fertilizers?
Well, it's interesting you mentioned CF because today it made quite the impressive move after testing the 50-day moving average. That little 50-day moving average. And so, whether or not it continues remains to be seen. A lot of it was basically not only because of the interest rates with England, but also because of the storm in Florida. There's kind of a knee-jerk reaction. All of the stores that sell supplies when those stocks rallied too, and so obviously fertilizer did as well. Longer term, fertilizer could be interesting. I have to be completely honest. I'm a commodities trader, right? So I really like to focus on the futures and I like to focus on the raw materials. Kane is an ETF. If you can trade futures, I mean, a lot of people are really scared about it. But if you get on the right side of a good futures trend, you can really make a tremendous amount of money. They get parabolic when they go, and you can actually almost throw the charts away until they get some kind of huge reversal top. But yeah, I would say CF Industries after today looks good. If it holds the 50, certainly worth a shot. I don't have the other charts just like right off the top of my head, although I thought Mosaic also did well today. But keep your eye on fertilizer is used to grow stuff, right? So you really want to understand, is stuff growing or not? Not necessarily if the fertilizer is going to help them grow, but what's in the ground now? How much is getting out? And how much of that getting out is being disrupted by whatever conditions are going on in the world, be it war, be it storms, be it labor, be it strikes. So I'm more of a purist when it comes to that kind of stuff.
Thank you. I love that. I love how you explain the thinking, like the underlying mechanisms behind that, the whole thinking process. So that all makes sense. So I appreciate that. Thank you. I wanted to ask you about the bond market. You talk extensively about JNK and HYG. And if you could tell us what you're seeing right now in those two bonds, that would be great. Thank you.
Well, this is definitely how you learn new things about trading, markets, relationships all the time. Doesn't matter how long you've been doing this. There's always something to learn. So, I couldn't tell you the derivation of what made me all of a sudden focus on junk bonds. Although I will say that one of the products that we have at Market Gauge that my husband Keith, who's the CEO, and by the way, we met. One part of the story that we didn't talk about, and we don't need to talk about, but I'm just going to throw it in now, is back when I was on the floor. The social life obviously was a lot of fun. It was the 80s, sex, drugs, rock and roll. I had a great time, but I never really thought about getting married from that. I was more into my career, and then I met Keith, and we wound up getting married. And Keith was an unbelievable commodities trader as well. He had memberships to all the different exchanges, so he was running around the floor trading what was ever hot. I learned a lot from him, and just in terms of following the next hot thing, right? Don't keep trading something that's dead. There's something else that's moving, and that's definitely the philosophy of a commodities trader. So a couple of years ago, when he was doing this Big View product, so Big View is all about the market internals, risk on, risk off. He kind of started me looking at the junk bonds, but then I, on my own one day, right before the 2020 crash, I looked at the junk bonds and I saw that they were breaking down and the market was still holding up. And I thought, okay, so these are high yield, high debt bonds that are breaking down at a time where we hadn't really heard the news yet about the pandemic, but at a time where equities were still really high, but somehow these bond traders were getting out of these positions. And so that's really what got me interested. And I actually, if we could go back in time, find my tweets from back then. I was saying, if junk bonds break this, watch out. And man, that ever turned out to be true, because as we know, by March 2020, junk bonds crashed. They went down to 84, and I'm talking about JNK. But what was interesting and different between then and now is that the TLTs bottomed and they started soaring because everybody went to the flight to safety because the Fed was going to get super accommodative and stimulus happened, blah, blah, blah. So we're in a different time right now. But getting back to junk bonds, what's so interesting is the high yield, high debt bonds. If you look at it relative to the S&P 500, even though it's completely risk off, it's actually on a relative basis still outperforming the S&P 500. So I wouldn't necessarily take that as the end all be all fact of what I'm saying. But what I would say is that if you watch that JNK or HYG, they're basically the same thing. If you watch those charts, you're going to get such a inside view to the bond trader mentality and the ultimate risk indicator to see if whether it's risk on or risk off. And very often, at least in the last 3 years, it's been like a little fortune teller. And so today they rallied, obviously, with the market, but they haven't gone anywhere near as up as they need to show that there's people like really the big bond traders feeling good about putting money back to work in these high yield, high debt companies. So I would be looking at junk right now very carefully before I would get too bullish. And they showed me they bottomed in 2020. They showed me first they showed they topped first, and then they bottomed, in April of 2020. And then they topped in November of 2021. They broke.
Yeah.
They were the first instrument that I saw to break the 50-week moving average, even before IWM and my family did.
I love that. Today, I believe it was earlier today, you tweeted, and your tweets are so important. Make sure you have notifications from Mish's tweets. They're very important. You tweeted, if JNK holds 84 to 85 and heads back over 90, risk on. We see it closed at almost 89. So I guess that's sort of passing your test. It's starting to get a little more interesting for you, a little safer.
Absolutely. Yeah. If it gets back over 90, and stays there. I mean, obviously, you can look at it from a day trade mentality, like for a minute it gets over it. But if it really looks like it's going to get back over 90, and we have a couple of other indicators that we use on our charts. We like to look at 6-month calendar ranges, which basically is the high and the low that's made in the middle of July and the middle of January. It's reset twice. And a lot of instruments retrace right down to their 6-month calendar range highs, and some like junk bonds and the indices, et cetera, all broke their 6-month calendar range low. So 90 is not only a chart point just on the basis of actually looking at the monthly charts or the weekly charts, but it's also a good calendar range reset to show that we may have actually bottomed, at least for however long that lasts. So that's another reason why I'm watching the junk bonds here. And if we're going to go into the crapper as an economy and into this deep recession, the junk bonds are not going to do well. So, like I said, they say it's smart money. Very often is these bond traders that really do a lot of fundamental research on the health of the economy, the health of these companies, and they sort of have a good quick pulse of what's happening. Not foolproof, but really, really reliable.
I love it. I love your system. You must love what you do because your passion really comes through. You must love this because I mean, it's just, I love the whole system, how everything comes together, these indicators, the family. This is great. Thank you so much for explaining that. Are you trusting this green today, yesterday, and today? I mean, they're sort of getting close to your test. I see you have IYT, if it trades above 205, and then it closed at 204. Semiconductors, you tweeted, if they rally towards 195 or even better, over 200, it's at 194. It's right there. Are you feeling more confident? Are you trusting this green, or you think it's a fake out?
It doesn't matter. That's my answer. Because whether it's a fake out or not, remember, we're talking about opportunity. And when opportunity strikes and you clear these key resistance levels, whether it's the ultimate bottom for the rest of our lives, a generational buy opportunity or not, is really, I mean, I love talking about the macro, obviously, and that's what people call me to talk about all the time. But that doesn't necessarily mean that my trading is going to reflect that, what I could see far out, like things going to hell in a handbasket inflation wise. I'm going to look at what's happening right now. And when I do that is when I make my best trades, which means I'm still a little girl on the Commodities Exchange looking at my point and figure charts going, okay, well, there's an OPEC meeting and they're going to cut production or they're going to raise production, but my chart's breaking out right here. So I think I'm going to buy. And it's really that simple. So as long as I know where I'm wrong, so let's take the case of IYT. If IYT gets through 195, let's say, I don't see any reason why it can't go to 200, 210, 220, still maintain its bear market status. But that's a nice move to catch. So that's how I'm going to approach it. If it rolls over from here, then we know this was sort of a one-day wonder. And whether it happens tomorrow, Friday, or next week, what have you, a lot of people are calling for some kind of a big bottom in October. Who knows? Again, right now, like I said, junk bonds settle. If transportation and the demand part settle, if the bonds don't start crashing and the yields start rising again, the dollar gave us a lot of relief today. If we're going to get a relief for the next month or so, next Fed meeting's not till November, no matter how much they jawbone on the airwaves, it could be a nice little rally here. So yeah, would I buy it? Absolutely, I would. I would be looking at, maybe not FedEx, but I would look at some of the other transportation stocks I like to follow, like JB Hunt would be a classic one, or Louisiana Pacific, or United Pacific, that kind of stuff. Or maybe even an airline, who knows? I love the basket of IYT. It covers trains, planes, and automobiles.
Love that. Yes, I agree. I mean, I enjoy talking macro too, and the macro is very bearish overall. But yeah, follow price, trade what's given to us by the market, and they can diverge. I mean, definitely tradable market, what we see. But if we talk about macro, we'll just turn into bears. I mean, it's just everything seems so bearish on that side. And I enjoy talking that as well, which is the segue to the next question. Although the definition has changed quite a bit, do you believe we're in a recession? And do you believe we're headed into, or could be headed into, stagflation? I know we tweeted about stagflation a few weeks or a couple months ago. Do you still feel that that's potential for us?
I think we're already in it. I think this is classic stagflation. We are seeing elevated commodity prices, even though it's not in every single sector. And we're seeing the economy basically slow down to a grinding halt. The big pop that we had after the pandemic was obviously somewhat artificially induced because we went from like being completely shut down to open. People went from not having to work for money to getting free money from the government. But right now we're seeing more of the reality of the situation. And right now we're showing that whether it's the projection of earnings going forward or whether or not we're seeing, great growth in our industrial manufacturing sector or even in the infrastructure package that the government has tried to get going, facing a lot of resistance. The point is we really, as an economic power, have limped in terms of growth. I think our best growth was what, 3.6% over the last several years. China, not that I want to necessarily always believe what China says, but China a couple of years ago was growing at 6 or 7 or 8%. So I think we've been in stagflation kind of since the pandemic. And whether or not that changes is going to depend obviously a lot on what happens with the Federal Reserve and what they do, how aggressive they decide to be. And really, if we can actually ever get the politicals to agree that we need to make some investment in our crumbling bridges, in our fact that our rail system looks worse than some third world countries do, that we still have more interest in buying from other countries that make goods cheaper because we can't compete in the United States. I mean, if you really want to talk about the US, we have the ability to be amazing. And even though we are more amazing, obviously, if you just look at our economy and our stock market compared to everybody else, we could be even more amazing. And it's really unfortunate that we're so divided right now. It's very unfortunate that we don't necessarily really have a system for dealing with getting our stuff within, exporting our stuff as opposed to importing our stuff. And, we're very manipulated by the central banks and by the lobbyists, unfortunately, special interests. But otherwise, this country has so great potential. So when people go, oh, it's the end of believe me, I have plenty of friends who sit around the dinner table lately going, I think it's time to move out of the United States. It's just going in the wrong direction. Well, the truth is we're bordered by two waters and Mexico and Canada. We're like geographically in the best position. We have natural resources up the wazoo. We just got to get over ourselves. And so you want to talk about the ultimate macro. That to me is the mega, mega, mega trend is, will we get our act together by some kind of consensus in this country like we were decades ago? During the 50s and the 60s when we really started developing the middle class of this country, so to speak. So, yeah, I mean, that's a really long answer, and it's something I don't ever talk about when I go on the media. But bringing it down to like right this second, right now, I'd say stagflation, possibility to go into a deep recession if the Fed can't figure out what to do and has to continue to raise rates into while many people are suffering, and also the possibility of a hyperinflation if they go the other route, and probably 3 to 5 years away from seeing any real growth. I think the growth will really come more from the digital age, however that looks. That's what Kathy Wood's whole premise is. Raul, stop. Sorry.
Okay, that's okay. I appreciate you opening up and telling us how you really feel, because we all, and I know I speak for everyone who's listening, value your opinion so much, your vast experience and your amazing trading track record, or whatever you want to call it. Your whole legacy is just brilliant, and it means a lot to me. And I'm sure I speak for everybody when that you opened up and tell us how you feel about that. So thank you so much. I wanted to ask you, do you know what happens? What's starting? What's going on in 17 hours? Do you know?
Is this a trick question? No. Tell me.
It's your webinar. It's your webinar. Well, Mish has an amazing webinar. I'm attending, just so you know, and I'm going to keep attending to these. But you guys need to know, if you haven't been, Mish has an amazing webinar that starts in 17 hours and 7 minutes. Marketgauge.com Mish Live. That's Mish Live. So just go, you sign up, you just put your name and your email, reserve your seat. It's easy. I'm there. I'm going to be there. I hope you guys can all join as well. And she talks about the 3 most important principles in her trading strategy. And she opened up and told us so much this evening, which I love. I'm so grateful for. But basically the macro bias, trade setups, and trade and risk management. I mean, to me, those are the most important, especially in this time period, in this market. Those are so important. So I'm attending. I hope you all can join as well. And one last plug for the book, because I got to tell you, I love the Plant Your Money Tree. Go to marketgauge.com/book. Mish, it's been real. It's been really amazing being with you for an hour and 20 minutes. And I want to thank you so much for everything and for agreeing. We talked about this weeks ago. I think almost a month ago we planned this. I had an idea and I said, "Hey, Mish, I want to talk about your book and I love all your stuff." And you said you agreed to meet with me on a space, and I'm so honored. I thank you again. I'd like to conclude this space, but before I do, is there anything else that you'd like to mention or talk about?
I guess just the final words would be, I have the passion that you hear is not just about the markets, but I really have I've devoted my life because I was so blessed with so many gifts to be able to think clearly, put things together logically, and then articulate that. I've devoted my life to wanting to help others, however that looks. And so really it's in that spirit. And by the way, just getting back to the women of Wall Street, it seems, I'm not going to call it a gender specific type of attribute, but there does seem to be a tremendous amount of traders out there, not just women, who feel that way. And I just think this is such a great, exciting time to be in the markets, because it's best to learn in the bad times, number one. Number two is there are so many people like Rosanna, the Women of Wall Street, other people that I work with constantly, some of the people in the media who put me on because they just want to learn something. This is a great time to learn. And, I was a poor girl from Queens, a daughter of a mailman school teacher, and I've created, through the markets, the purest form of capitalism, an incredible life. So my blessings become your blessings.
Oh, amazing. Beautiful. And you live in Santa Fe. Love Santa Fe. It's gorgeous there. So it sounds like you've created an amazing, wonderful life. And I wish you the best always, Mish. Thank you so much for your generous time. And that's why we're here. Ultimately, it's to help each other. That's my main reason for coming on Twitter, was to share my experiences and knowledge in my life and what I've done with business and real estate, investing and equities and everything. And it's just to give back and just to help others, whatever I can do. And I'm so grateful. And I know you are a teacher and you teach us all every day with your tweets and every time you speak. All the beautiful shows that you're on, with Cavuto, to all your interviews, you're always teaching. You're a teacher at heart, and it comes through in everything you do. So thank you so much, Mish, for everything you do for all of us, whether women or men or dogs or anyone. Thank you for all you do. And I love that little Raul, so cute. Give him a hug for me. Love dogs. So thank you so much. And we will see you at your webinar in 17 hours, marketgauge.com/Mish Live. That's it. Thank you.
Rosanna. Thank you so much.
Take care. Thank you. Bye-bye.
Bye-bye.
Thank you all for joining. Have a nice night.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.